Recording in progress.
Good. All right. Are we ready to go ahead and get started? Very good. Well, very good morning to everybody. Hello, I want to welcome everyone participating in today's webinar, Building and Maintaining Operating Reserves. This is part one of our three-part series on developing a strong accounting foundation for nonprofits. My name is Christian Spencer. I'm a partner here at GRF. Today I'm joined alongside by my colleague, Melissa Musser. Melissa is a partner and director in our risk advisory services here at GRF. And we have a lot of great stuff and a lot of great information to share with you today. So we appreciate you spending part of your morning with us. Participants that are looking to seek CPE must complete and submit a short survey, which will appear following the webinar in order to obtain the CPE. Please participate in each of the polling questions throughout the session, as that will be our gauge of your active participation. Also, please note this webinar is not intended as a financial or legal advice. This is simply educational purposes and the perspectives of two individuals that have spent a career working in the nonprofit sector and working on a variety of risk matters. So just a little bit about who we are. We are GRF CPAs and Advisors. We're based here in the Washington, D.C. area out of Bethesda, Maryland, serving clients nationally and internationally. Our firm serves a wide range of clients covering the nonprofit space, for-profit space, schools, government contractors, and a number of other types of organizations. However, our true focus and our true passion is in the nonprofit INGO space. And so we have been in operations for several decades serving this sector, and we are thrilled next year to be celebrating our 45th anniversary. So as you can see here, we have a lot of exciting content to cover. So without any further hesitation, we can go ahead and get started, and I will pass it to my colleague, Melissa.
Great, thanks. Well, we've already went through the firm background, so we're going to talk a little bit about the need for better risk oversight and, the connection there with strategy and how to, really identify the directions to go via managing that risk. And we're going to segue that right into operating reserves, and I think you're going to love it. So let's see if I can get these slides to move, though. All right. Goodness gracious. Okay, guys, I'll get a hold of this. All right. So I usually like to start with this slide if you've ever seen me before on talk, and I always kind of mix it up because the world is constantly changing. But one of the things I always like to talk about is if I were to meet with your board of directors And I would sit down and talk with you and I will ask, okay, what are your goals and objectives for the year, right? And most organizations have some kind of strategic plan and everyone's on the same page as to what their major goals and objectives are for the year, for the next 3 years. And I say, okay, great. Then what are the biggest risks to you achieving those goals and objectives? And I tell you what, unless they have enterprise risk management in place, they're not going to agree on that. And that's a really big deal. And obviously, that affects your reserves, right? Or what you're building or what you're trying to build and achieve. So, this is really, really, really important and critical. And it's the board's responsibility to oversee the risk of the organization. So, if no one's on the same page as to what the top risks are, you can see how this is even a bigger problem that needs to be addressed. And it's not that difficult. And honestly, if you were to do a strategic plan, you're supposed to do SWOT analysis, right? You're supposed to look at your strengths, weaknesses, opportunities, threats. Really buried within there, we should all be getting that consensus, but it's just not happening. And I think with some simple tweaks and a change of the way we think, we can get there pretty easily. And that's what enterprise risk management really does. It changes the culture of the organization. One of the other issues that we see is folks aren't on the same page with terminology. So even just saying, okay, what is significant? How many significant risks do you have in this example? And again, we partner with NC State a lot, and this is one of their slides. Let's say the board members say there's zero, right? And so in my previous example, maybe they weren't given any information on risk and they don't think there's any. Or maybe they have the correct view of risk in the sense that, yeah, there's risk, but nothing significant to the achievement of our objectives. We're on track. And maybe that's the correct view. I'm not really sure, right? So, the CEO may say there's 13. Of course, the chief technology officer says there's 17. But again, is this individual speaking from the perspective of just their unit? We have 17 very significant. Or are they speaking from the perspective of the direction of the organization? I know I've worked with some nonprofits where if their IT systems went down, even for 2 weeks, they would be fine. That's not significant to them, right? I mean, it's a big deal, but it's not the biggest deal in the world. And some organizations can't exist longer, going down a couple hours. It's a major revenue loss. So really defining what is significant, right? Putting that into some sort of playbook so that when folks talk, we're all talking on the same page as to and it's not just someone's opinion, that there's actually a methodology for understanding what is significant. Nathan, if you can move my slide, I can't. They're not moving for me. Okay, great. So typical risk management is still great. We love risk management, right? So there's a difference between risk management and enterprise risk management. You will see a lot of folks there misuse the terminology. I think maybe because ERM is a buzzword. Be on the lookout for those folks. I've even seen some folks, titles have changed. They're enterprise risk manager, even though all they do is insurance. And yes, they do enterprise insurance, but not in the context of enterprise risk management according to the frameworks such as COSO and ISO, right? So just be careful and make sure you fully understand what you're getting yourself into. But traditional risk management is just stovetop, right? And so you're still going to have legal and compliance put together their legal and compliance risk register. You're still going to have the IT folks put together their risk registers. These are all important, right? The problem is the dots aren't always being connected. Or let's say, certain individuals, if legal and compliance is the one, reporting out risk, they're going to be overly compliance focused. Or the CFO, if they're the ones managing risk, which we do see in a lot of nonprofit organizations, it may be overly, accounting fraud related focus. So, ERM helps bring that all together so that we have a holistic view of what's going on. So here's just another view of it. You have your risk management, which is great. You have your strategy, right? Enterprise risk management sits in the middle of that. And it also helps us look at our strategy, which is really important. So here's another view. This is what I love. And again, this is simple. We're not asking for a lot here, but this is just another view. So we're basically taking all the risks that we have and we're applying it out through our strategy, right? And you'll see here strategic initiative 1 is in trouble, right? And maybe without this view, I wouldn't have really understood that to say, hey, wait, maybe we need to completely pivot this initiative. We need to go a different direction. I know we saw that with COVID. A lot of folks' programs had to completely change the way that they delivered, or they maybe came up with a whole new strategy here. So this is an example where you can be really nimble and change your strategy based on risk, right? That's why the left hand needs to talk to the right hand. These aren't separate. they're just the opposite side of the coin, right? And so here you'll see risk number four. Gosh, we really need to invest in this, whether it's through, building up the reserves like we're going to talk about, or we need to invest in some technology because it affects absolutely everything that we're trying to achieve. And without this view or understanding, I might be spending a lot of time on risk number two because, cybersecurity, everybody's talking about it, but really risk number four could be, talent management. And it's like, guys, we don't have the talent, we're not going to exist. We have to go all in, pay our people the best, give them what they need. And you kind of can see where this really helps you make smart, good decisions. You work smarter, not necessarily harder. And this is what I was talking about earlier. If you feel like doing some exciting reading on enterprise risk management, there are two frameworks out here. Both were updated in 2018 and 19, basically to say if strategy isn't at the center of risk management, you are doing it wrong. You're doing it wrong. That's really, I just saved y'all a bunch of time. If you have risk management and strategy is not the core of what you're doing and it's not connected to your strategy, you're doing it wrong. Start over. That's all I have to say about that. So again, there was this thing called the three lines of defense. Some of you might be familiar with it, some of you might not. I just point this out to show you for the next slide. The three lines of defense is very popular. And you'll notice here, and it's really small, but you'll get these slides. But in the middle of the old line, you'll see that risk management was its own little section of the second line of defense. And in this new model, which came out in 2020 from the Institute of Internal Auditors, it's just called the three lines model now, right? Because we're not on defense, we're on offense. All right, so you'll notice that risk management is no longer its own thing, because what they found is that when there is an individual that has risk management as their title, a lot of folks will think, oh, well, risk management isn't my job. I don't need to do risk management. This is other person's job. When in reality, everyone's a risk manager, everyone's responsible. Now, we can still have risk managers, chief risk officers, all those things. That is not what this is saying. What this is saying, those individuals can facilitate the process, can communicate, do all these wonderful things. The point is that management is all collectively responsible for risk management. And that's kind of the point of that whole thing I wanted to share with you. And so this is one of the structures that I like to suggest. A lot of times organizations already have an executive leadership team meeting. So I just like to call it a risk council, right? This is just my favorite way to frame it. This is how when we do our enterprise risk management playbooks for folks, this is what we call it. Call it a strategy council, call it leadership group, whatever. It's key leaders getting together to share the top risks from all those different departments, right? Those different silos, get together, talk about top risks to those strategic objectives, come up with a concise list that gets communicated up to executive leadership and over to the board or the audit committee. It helps bring it all together, which is what we're really trying to do, using all the same language and all the same concepts. Now, you can have someone like your chief risk officer or a risk manager be the chair of this council and facilitate, but you don't have to do that. We've seen a lot of different folks be the chair of these risk councils. It could be legal and compliance or the CFO, or that there's really no wrong way to do it. And we'd certainly be happy to help you talk about this. But any size organization can implement this in order to really, really see the magic of enterprise risk management. So I wanted to share some slides and this is from NC State. This is something that's out there. It's called the State of Risk Oversight. It's a nice survey, just to make you aware of it. But I just wanted to point out that most of the time, who's responsible for risk oversight? It's just, like a favorite thing I like to point out. Obviously, your board is, right? But they may delegate that authority to an audit committee. We see 64% of nonprofits do this, right? So most often, that's who's going to be responsible for overseeing risk. So I would urge you to go pull out your bylaws, look at your audit committee charter. What does it say in there, right? Does it say risk oversight? Are you reporting risk to them? Well, you may be out of compliance with your own charter, or maybe you need to add it to that charter, because if those conversations aren't being had at the board level, which they should be, maybe they should be at the audit committee level, kind of just depends on what you want to do. But you better make sure that you're having some sort of risk conversation, strategy related conversation in your minutes. It's required. It doesn't have to be a ton of risks, right? Here you'll see in the next slide, this is the next big question we always get. All right, well, how many? Well, certainly this isn't enterprise list management. No one wants to see a list of 100. I've seen some scary, scary lists, even 20 or more, only 2%. So we're talking about like less than five, like the top three, right? Because we're talking about the significant risks. All right. The significant risk to your strategy, the board or the audit committee or whoever is delegated needs to be having those conversations. Those need to be presented out to them on what's being done about these top risks. How are they being monitored, right? So if it was over dependence on funding, if that's a big one, that should be, let's talk about it. What are we doing about it? What's our plan? This should be always monitored. Once it hits a certain threshold and it's your biggest risk, we need to have those conversations. It needs to be on our radar about what we're doing. All right, looks like we have a polling question. Are you still listening? Hopefully, yes. All right. Okay. So here's another slide. We're going to be doing a top risk report here soon, which should be coming out. But one of the things I always like to do is look at the Institute of Internal Auditors global trends. What's really great about their risk reports is that they break it down by region. This is their global report, but they have like North America. They have all the different regions of top risks. So this is the global one, and you'll see here that cybersecurity is the reigning champion of risk and is expected to be into the foreseeable future. So if you're not really having those conversations at the board level, you probably need to have pretty good justification why you're not. Incident happens, look at the minutes, no conversation, that's negligence, right? So be aware that that's a big deal. But we're seeing digital disruption. It's going to be moving into, the number two spot here soon. Kind of ties in with business continuity. And then again, human capital, so just labor. So it's a lot of the same ones over the past few years, just kind of moving around and moving and shaking. But, if I came in to look at what you got going on, I would expect to see those. And if I don't, I would probably be asking you, what's your methodology and why aren't they your top, or are you missing something? But again, this gets back to organizational context. Everybody's different. Everybody's operating in a different industry. They have different strategic objectives, different culture, structure. They could be remote only, or they're not dependent on IT systems at all. I believe it or not, there are still organizations out there like that. So everyone's unique, everyone's different. You can't copy someone else's reserve methodology or strategy or risks, right? So know that understand your context and go from there. There's a few different ways to figure out really what your risks are. If you've never really gone through that process, well, I think you probably have, because like I said, if you do a strategic plan, you should have done this exercise. Your strategic planning partner should have walked you through some sort of exercise to figure that out. If not, maybe ask for it next time. Really, really look at this. But one of my favorite ways, and again, to remind you all that if strategy isn't at the center of your risk, you're doing it wrong, is the objectives based. So meeting with folks and saying, let's say I'm meeting with someone in HR and I say, okay, what are your goals and objectives for the year? And hopefully what they tell me cascades down from the goals and objectives of the organization as a whole, right? So I always like to start at strategy and move my way down. So if they don't even know the strategy of the organization, that's obviously your first problem. And then second is, okay, well, what's going to keep you from achieving those goals? And they could say something like, we can't pay our folks enough, or they're going to say, we don't have the IT systems, or we're too stringent on, remote or come into the office. So this is where you get some of that information. So if talent management is our number one risk, well, then that informs maybe some change to our strategy and how we approach it, right? So that's how the risk is the other side of the coin, and it's just another way to try to get the risks and try to work on filling out a risk inventory. I could obviously go on and on and on here on how to do this, but one of my favorite things to talk about here is also trying to figure out what is unknown but knowable. And so that was kind of getting back to that objectives based questions, because I always like to talk about the Blockbuster example where they had risk management in place, right? But what they missed was a risk in their strategy and the way that they were going. Now, that was completely knowable. We can all be, the Monday morning quarterbacks and be like, come on, man, that was obvious. But, so it's unknown at the time, but it's knowable. We want to try to figure that out, right? And we want to try to be nimble. So don't just always focus on the known knowns, but also, most big catastrophes that happen are things that didn't really surprise you, I mean, except for COVID, right? But that didn't really surprise you. But just no one did anything about it. And so that's the other area that's really important is, Okay, so now we've identified our risks is like, okay, so what are we going to do about it, right? We're going to try to reduce and mitigate that risk, right? Maybe implement controls, build a reserve. We're going to talk about that. You may want to just eliminate and avoid the risk, maybe not operate in that part of the world, or maybe just not work with that partner. We're just going to cut that off. We're not going to even do that. We're not going to even try to get into that space because there's too many legal requirements, whatever that is. You're going to transfer the risk, maybe outsource it to a third party or get insurance. You can do all these things actually based on any risk. You can accept the risk, just monitor it, and then you can exploit the risk. So figuring out, and so this again becomes part of the strategy. So we like to talk about cybersecurity as like this major risk, right? All right, well, what if we exploited that risk? What if we became the best in cybersecurity? What if we just put all in there and then we advertised it? And so then our clients want to, like, folks want to work with us because they know their data is safe. We have now made our biggest risk our biggest asset, right? So it's just flipping that around and thinking of it another way. And that's a really important part of enterprise risk management and why it's so keen and critical for strategy. And this gets back to those very top risks. You must have a handling plan, and it needs to be owned by an executive risk owner. And if it's meeting the threshold of significant, those handling plans need to be going to the board or the audit committee or the delegated committee so that folks can understand what is actually being done. And I'll just, if I have some time, my little soapbox here is cybersecurity. Number one risk, right? And maybe you have an outsourced provider or you have a chief technology officer. You're going to want independent assurance on that. So having that individual report to you saying everything's great. I got an audit. I, as the chief technology officer, engaged a third party, designed the scope myself, had them engage with me. They got an audit done. We're good. Do you see the problem with that? That's, you need to have independent, if it's a top risk, you need to have an independent individual organization come and provide assurance over that. That would be like, your CFO not having an independent audit done and them being able to scope things out, say, I just want you to look at accounts payable and nothing else. And so then I'm going to report to the board that like accounts payable is really good. We're solid. That's how when I look at some of these IT reports, that's how scoped out and slivered they are. And folks don't even realize the amount of scope that's being missing there. That's my little soapbox about this. But if cyber really is a big risk, you really need to look at independent assurance and really understand what these cyber reports that they may be providing to you even mean, and that you're getting the assurance that you need. Once you've decided what those top risks are and determine that, and again, this process should happen at least on an annual basis or after any significant change. You should look to try to develop KPIs and KRIs, a key performance indicator. You may already be doing that with your financials, and a key risk indicator, right? And so that could be a metric like turnover, right? If HR or attracting talent is a big one, you could say, all right, I need to be alerted if turnover hits this certain threshold. So that way, it's like a lot of times HR knows there's high turnover, but maybe the board doesn't know that until it's too late. So it's setting that threshold like, okay, we know this is a top risk. This is a top strategic imperative for us. So when it hits this threshold, I want to be alerted immediately so I can act on it. Because a lot of times, maybe it's IT or HR, they will hold that in and they may not report it out for whatever reason. You want to have that information flow. So again, it's not overly complicated. Just do it for the top risks. These are things that you can work to try to implement, and it's not total rocket science. You don't need some big GRC platform. It's just some simple things that you can start to do. So, next question. Are you still listening? All right, I am now passing it on to Christian.
All right. Thank you very much, Melissa. And the next couple of slides here, we're going to really just kind of move into correlating what Melissa was talking about in terms of ERM into how would you kind of approach this with your financial reserves. And one of the things that we take a look at when we work with organizations that have an ERM in place and have come up with these risks is really targeting the reserves in a bullseye fashion versus just a kind of shot in the dark. And many on the call may remember in years past, one approach to reserves was simply a benchmark saying, let's have 9 months of operating expenses in a reserve for a rainy day. But, they weren't really able to define what that rainy day was or what kind of events would transpire that would necessitate the use of those reserves. So this exercise that we're going to walk through here a little bit kind of demonstrates your ability as an organization to fine tune your reserves using an ERM approach. And one would say, well, why would I need to do that? Well, when it comes to financial assets that would be necessarily tagged to these risks, and we're also going to add in opportunities as well, because when we look at reserves, we like to think about reserves being used not just to address a risk or a catastrophic event, but also for the betterment of the organization, growing the organization, adding value to your members. So reserves really serve a dual purpose. But, a lot of our clients oftentimes get the question, well, why do we have all these reserves? What's the purpose of the reserves? And instead of just simply saying, well, we have it for a rainy day, under this methodology, you'll be able to actually target it to some specific risks and some specific potential opportunities that would add really what we call a more defensible position for your reserve. So when we think about reserves and we correlate ERM to reserves, starting at the top of this really kind of funnel here, it all comes down, as Melissa was indicating, to your strategic plan and what's the mission and critical risks of your organization. Everything you do as an organization should really revolve around and kind of build off of what your strategic plan is. So you take a look at the strategic plan, you dive into where some of the risks and or opportunities may be present in that strategic plan. Then you move to your operational plan. And that's really how are the resources that you have as an organization going to be deployed and used to execute your strategic plan and address these risks and opportunities. Building upon that is the financial plan. This is where we come in and quantify the risk exposure, with those risks and those potential opportunities, and try to tag a potential cost with that through a kind of strategic initiative. And so when you tag the cost to it, as you're going to see in a couple of slides, it really is a very subjective process. You're going to be looking at past events, sort of replacement costs in the marketplace. There's going to be a level of prognostication out there based upon, for example, if you're going to anticipate needing to do a top level executive search, what would that cost your organization, maybe based upon what other organizations have done. So again, it is really like budgeting for these risks and opportunities. And as we know in the budget process, you kind of go based upon historical data and some sort of prognostication of future costs. So that's the element of the financial plan. Then once you have sort of your cost tagged to these risks and opportunities, you really tag that to your reserve plan or your reserve policy. And you'll see in a few moments how this one organization was able to identify risks and opportunities, and it dictated the need to increase their reserves and how they kind of strategized to do that. And then finally, of course, your reserves are invested under hopefully what you have as an investment policy. And you want to make sure that the reserves are really put into sort of a short-term duration and a long-term duration, because then you're able to align the risks and the timing of the risks and the magnitude of the risks with your investment policy. And so that would be something you would work with your investment advisor with. And if you had a certain number of risks and opportunities that were in short term, that may dictate what your short term investment policy is versus a long term policy as well. So when we look at kind of scenario identification, and again, this is a lot of what Melissa was talking about just in terms of identifying potential opportunities and risks. Each organization is going to be a little bit different. So you start with a qualitative assessment of your identified risks and opportunities. And when you go through this exercise, it shouldn't just simply be the CFO doing this. It really should be what we call a 360 kind of degree all-encompassing project. And some of the best organizations I've worked with on this, it may start with a small group of people to kind of identify what their risks are, whether it be the CFO, certain program managers, certain department heads. But then that group becomes larger and you involve the CEO. You certainly involve board members and constituents, because they have a responsibility, as we know, for governance. And so they certainly play a role, particularly in member organizations where your board members are oftentimes members of the organization. They should play a role in identifying these risks and helping you to quantify these risks. So throughout this process, you are going to look at your risks and opportunities, and you're going to establish, sort of individual to each organization, the likelihood of this occurring. And you can see here I have the X's kind of highlighted in yellow because this is going to be dependent upon each organization. What we generally see is looking in a range from 3 to 5 years. So if you believe that it's going to be, an event that's within 3 and 5 years, you kind of tag it as highly likely, medium likely, or moderate, and low or remote chance to occur just based upon the specific event or opportunity. Then you look at the magnitude, and the magnitude is going to be the quantitative piece of this. And is it going to have a high, medium, or low financial impact to the organization? And of course, the dollars associated with this are certainly going to ebb and flow depending upon the size of your budget, the size of your organization. So the goal here, as you'll see in a few moments, is to assign a numeric dollar amount associated to each risk and opportunity for the organization. And that's going to be what you anticipate potentially happening. And then you're going to align that with your reserves and see, where do your reserves fall sort of within line as to the identified risks and opportunities. So I think it's important to define really when we talk about reserves, different strokes for different folks, different organizations and different people sort of look and define reserves differently. For the purposes of what we're doing today and the purposes of kind of when we're working with organizations, this gives you a fairly simplistic example of how we would define reserves. So if you start on the spreadsheet here, kind of working from left to right, you can see the organization has $5 million in assets, 1.2 million in liabilities, and then 3.8 million in net assets. So if you move to the right hand side of the slide, under the reserve calculation, our definition is we take net assets, which in green there is the 3.8 million. You take out your donor restricted net assets because in theory, those are related and sort of identified for specific donor purposes. So in general, they're not available for some of these identified risks and opportunities. So we want to subtract those out. And then we also want to subtract out property and equipment because, as we all know, that's a non-financial asset that's not really going to be readily available in a liquid form to address any of these matters. So you come up with a number of 2.5 million in our example as what we would define as the organization's reserves. And essentially that's going to be your assets, sort of less your liabilities, less fixed assets. And we take that as a percentage of your operating expense because we want to look at reserves really as a percentage of operating expenditures. So sort of your reserve ratio. So in our example here, the reserve ratio for this organization is 42%. So again, that's just the way we're looking at reserves. Oftentimes, organizations will just look at reserves as what's sitting in a particular investment account, but that may not necessarily be a true factor of reserves available for events like this. If you've got a collection of a significant amount of deferred revenue in advance, and that's parked in an investment instrument or things like that. So you really kind of need to drill down and see what do you have available in terms of liquid assets that are not restricted. So I want to spend just a few minutes on benchmarking, and I don't want to suggest that benchmarking is not a good method for getting comparable financial data for similar organizations. But I would argue that really your individual reserve policy should be tagged to what you as an individual organization identify as risks and opportunities. And while, as Melissa said earlier, there are going to be some broad-based commonalities across all organizations, particularly in the realm of cyber, there are going to be some specific risks that your organization may face that others don't. So again, that's why we take this sort of pragmatic bullseye approach in analyzing the risk factors and opportunity factors. So again, in this example, this is an organization I worked with a number of years ago that was in the architecture space, in the design build space. And as part of the work that we did with them, we went through and gathered some financial information. All of this is available vis-a-vis the 990 that's accessible on guidestar.org, and just to do some basic benchmarking of similar organizations. And again, I think in this situation, it adds some context to the membership and to the constituents that you're looking at what they deem to be similar sort of peer groups as you're coming up with this analysis. So again, each organization structure, revenue streams, and risks are going to be different. So in this example, you can see sort of from top to bottom, the first organization had 110% of their expenses in terms of a liquid reserve at 110% there, working your way down to the bottom where you had an organization that only had 12%. So again, this is just another way to sort of look at what's out there in the marketplace in terms of reserves. But different organizations are going to have different funding models, depending upon how they earn their membership revenue, different risks, and also the availability of cash as well. So I think the takeaway here is that it can be helpful in terms of benchmarking, but it shouldn't be really the do all end all as you work out your reserve policy. So again, sort of along the same lines as benchmarking, another common question that we see out in the marketplace is how much is too much? I'm a nonprofit organization. I really should be executing my mission with just about all the dollars that I have, and it's not a good look for me to have reserves. Again, this is going to be predicated on the type of membership you have, the type of constituents you serve, the type of exempt status that you have. But I think it's important to note that as a nonprofit organization, there is nothing out there saying that you can't hold reserves and that you are required to hold a minimal amount of assets because of that exemption. Those two things are not tagged to each other. The only sort of exception to that would be in that third bullet where we look at private foundations. And there is a rule that they need to spend 5% of the value essentially of their endowment in further of charitable purposes. So these private foundations do have a minimum spend policy on an annual basis. But your appropriate amount of reserve is going to depend on your individual event identification and risk. And you've got to look at the nature of the revenue streams that you have, the ability of cash in a readily accessible manner to really determine what level of reserves that you have. So again, the concept of I shouldn't hold cash or I shouldn't hold reserves because I'm a nonprofit really has no good faith basis. That's not to say that you shouldn't have a defensible position to your membership and to your constituents for explaining why you have reserves. And that's again the process that we're going through here today. So again, I wanted just to spend just a couple of minutes on a few sort of samples here so you can see how individual organizations sort of address their reserve policy. So in this situation, this is an individual membership organization exempt under 501c3. As you can see there in the second bullet, they have a very, very diverse stream of revenue generating functions, about $11 million in annual revenue. But their annual dues, which is upwards of a third of their revenue, come from 19,000 individual members at a very, very small dollar amount. So again, they're working on a high volume of individual transactions at a very, very small dollar, unlike other organizations that may have different funding models from the membership side. So cash is not readily accessible for them in terms of any kind of assessment to a member, a large corporate member. They are not really in the charitable fundraising space. They're more in the sort of individual membership space. So they need to maintain a liquid reserve of about a year's worth of operating expenditures. And that's what they determined based upon, sort of their risk model and their funding model. And again, they've determined that having these reserves would enable them, should there be a shortfall in revenue or some unexpected expense to mitigate the need for staff reductions and continue to provide services to their constituents. So another type of model for a 501(c)(3) organization, this is quite a bit different. This is an organization that's primarily funded by federal grants. And this example was before, I should say, the events of the past 10 months or so. They had adopted this mindset back a number of years ago. So the vast majority of their revenue were from federal agencies, federal grants, about 3/4 of their revenue, $20 million annually, minimum reserves, and they relied heavily upon a line of credit to bridge the cash flow shortfalls because these grants were on a cost reimbursable basis. So, many times they were expending under this scenario, as many are, expending the funds up front and then getting reimbursed from the government after the fact. So if there was any gap in that timeline there that was of significance, they relied on a line of credit. But they realized that they had so many more opportunities out there to continue the good work they were doing with their exempt status. So they launched a very, very robust fundraising campaign with the sole purpose of creating an endowment. And the idea behind this was very, very well thought out in advance because they wanted revenue diversification through other initiatives and not be so reliant on the funding from the federal government. So the idea was to create an endowment, and it was very, very much spearheaded by certain high sort of net worth individuals, members of the board that were able to sort of reach out into their marketplace, reach out into their constituent base, and help build this endowment for which a certain percentage of the earnings, again, would be used upon annually. And that was a very, very highly successful initiative. Another example, again, we're moving now to a 501(c)(6) organization that administers a certification program. And so nearly all of their revenue is through the administration of an examination. Again, $12 million of revenue annually. But similar to one of our previous examples, it's a concentration of small dollar, high volume transactions. So again, their revenue model doesn't facilitate having cash available through any kind of assessment to a membership or any kind of fundraising mechanism or grant mechanism. So they maintain a reserve greater than a year's worth of their operating expenses so that they can continue to provide these services. And then one final example, moving a little bit away from the risk model and more towards the opportunities model. This is an example of an association whose largest source of revenue is a domestic show held annually in the US, a very, very successful show. And they started to think, how can we diversify our offerings geographically, sort of throughout the world, and be able to monetize the good fortune we've had domestically, kind of monetize it internationally. So they made a decision as an organization to use reserves to purchase an 80% interest in a European-based show that runs a similar type, or organization that runs a similar type of show. So the strategy here was not risk, it was advancement of their service offerings to grow the sort of global reach of the organization outside of the US and appeal to an international market. So they were able to use reserves to access or to acquire that show. And they made the strategic decision to retain some of the services of the minority member who's really the boots on the ground at the foreign country to help run the show because they were more familiar with some of the local laws and customs like that. So again, a very good strategic decision by them. So again, those were just some of the examples of types of organizations and types of funding models that they're considering. Certainly in our current operating environment, we've got a lot of, as we well know, political uncertainty, loss of grant funding during 2025. Those two sort of go hand in hand. I wouldn't say I've seen a lot of or really any meeting event cancellations or reductions in attendance. But what I have seen is organizations remember several years ago when during the pandemic, this was a real issue that had to be addressed in short order that organizations weren't necessarily accustomed to dealing with. So this is something that organizations are considering, particularly if they rely heavily on attendance at an annual event. They're factoring in, a potential another event that could reduce attendance and reduce revenue into their reserve calculation. Decline in members, depending upon the nature of the organizations that you serve or the sector that you serve. We're seeing consolidations in the industry that oftentimes the consolidated organization doesn't necessarily get as much revenue from the members as the standalone organization did. So that needs to be a factor as well. Office space, either we're seeing this really go both ways. Organizations, some are downsizing and going to a remote environment. Others are saying now is the time we need to be present in person more than ever, particularly those that do a lot of lobbying on Capitol Hill. So we're seeing some increases in space or some reconfigurations. Melissa mentioned cybersecurity previously and the important role that will forever really continue to play in an organization's risk assessment. I wanted to mention availability of lines of credit because this is something that we saw a lot of activity around, particularly during the pandemic. There were several organizations that I had worked with who either their events had been canceled or they had a loss of funding for a litany of reasons. And they really didn't want to have to position themselves to sell their investments in a down market. I mean, the early stages of COVID, the market was down quite a bit. And so they were strapped for cash because the customary cash flows that had been coming in from these meetings and events were not there. The down market didn't really give them an opportunity to want to sell their securities and take a loss. So some were scrambling for lines of credit. So, all organizations really should take a look at, having a line of credit, the cost benefit of having a line of credit, and really being able to play that arbitrage. If you need cash and it's a down market, and the interest rates on the line would be more favorable to you than potentially selling your investments at a loss. Financial markets, again, revisiting investment policies, aligning those policies with the reserves that you have and the timing and the need. Endowment draws are a big discussion item that we're seeing out there right now. Are you taking a 3-year average? Are you looking at the year-end amount? What percentage are you taking? Succession planning is another item as individuals that have had some of these long-standing positions move into a retirement phase of their life, and what has the organization done to really plan for the succession, the next CEO, the next CFO? And I would say this really isn't isolated to the top 1 or 2 positions in your organization. You should be looking at department heads. You should always be looking at, the succession planning of an organization and some of these key roles. And then finally, we use a term called contagion factor, which is, you're never going to be really in a position or in an environment where just one of these aforementioned events happen. Generally, these things kind of happen either in tandem or sort of in a domino style fashion. So you've got to look at it from that perspective as well. All right, we will move to our next polling question just to make sure everyone is continued to be engaged here. All right. So what we want to do now is the last couple of slides here, based upon the aforementioned sort of examples that I gave, the intel that Melissa provided to us early on, want to walk through a sample reserve policy for an organization and kind of how they went through this and what they identified in the process. So to put all of this sort of theoretical discussion into the context of an actual example. So here we've got an organization whose current policy is to maintain 7.4 million in a long-term reserve to fund and finance long-term projects, new opportunities, and maintain the stability of an organization. As you may recall earlier, we talked about sort of that qualitative assessment of opportunities and risks using the terms likelihood and magnitude. So for this organization, they elected to look at events that were going to occur within a 3-year time horizon. And what they were, their sort of prognostication was we're going to look at things within the next 3 years. And then as we get to the close end of those 3 years, Then we're going to kind of reassess and take a retrospective review as to what happened, and then sort of look out maybe another 3, 4, or 5 years. So that was their, sort of their protocol and their decision based upon input from management, input from the board, and again, that 360 sort of degree view. In terms of magnitude, they really defined high magnitude impacts of anything more than $1 million, moderate between 500,000 and 1 million, and then low financial impact based upon 500,000, just to put some kind of guardrails around the magnitude of the events. So, here these were the identified strategic opportunities that they came up with. And again, remember, we're looking at opportunities sort of separately from risks. And, we believe that it's a good idea to kind of parcel those two out, so that you can, you can maintain a reserve sort of collectively, but looking at the opportunities and the risks separately, give you an opportunity to kind of look at these in isolation. So here in our example, working from left to right, the likelihood of these four events were deemed to be a medium likelihood, with the first event being a high magnitude and the next three being low. So the first event was the potential purchase of a trade show. This was an organization that, like many, had did it sort of operated in a similar space to another organization that ran a trade show, and they believed, looking out, that there was a real possibility they could purchase this show to provide more value to their members and their constituents. So they tacked a dollar amount to this, again, based upon what they knew to be the history of the show and what they knew to be the likely sort of kind of estimated purchase price of what this show would cost them. The next item was enhancement of educational offerings on that second row. And again, they saw the opportunity to branch out in terms of the offerings to members, education in the industry, and they thought that they could, perhaps develop a few more programs down the road. And based upon historical costs that they had done other educational programs, sort of factored in with an inflation factor, they came up with 400,000 as a potential need for that, should they go down this strategic opportunity path. Again, additional membership recruitment, from an international perspective. They had primarily been a U.S. domestic organization, but the sector they were operating in gave some opportunities to reach out on an international appeal, and they saw some benefit in spending some dollars there to reach out and have a broader based approach, sort of throughout the planet. And then all of these things, require additional staff. You can't just continue to pile on to the existing staff, as we all know. So, having the resources together to execute, some of the above, mentioned items was going to cost some additional staff support initiatives as well. So, all in all, the gross amount of this potential opportunity, again, should all of this come in an estimated fashion, was about $3 million, that they would want to have available should they elect to sort of move down this path. So keep that kind of $3 million in mind as we move to the next slide here. So again, after they took a look at the opportunities, they also looked at, did a kind of a similar analysis around the risks at the organization using the similar sort of framework and mindset. Again, looking at likelihood, magnitude, and then the gross potential amount. So again, this is an organization that's in the C6 space, and they do a lot of lobbying efforts. And at the time, there was quite a bit of legislation around initiatives that impacted their members, and they saw that there was going to need to be a continued increase in lobbying efforts in the industry throughout the next couple of years. And they took a look at this as additional lobbying efforts into what they already spend, because as we know, sometimes things change or don't change on Capitol Hill on a dime, and you may need this money and may need these funds to be available on short notice. So that's sort of the way that they looked at that, the positioning of that reserve element. Certainly a decline in the investment portfolio, just in terms of the unpredictable market space. These are where your reserves are. You don't know, sort of if the market's going to go up or down. So being insulated from that risk was something that they wanted to take care of there. As Melissa mentioned earlier, the IT, not just the security around IT and the IT cyber That's certainly one piece of it, but also keeping up with the technological advancements that we're all experiencing these days, whether it's a new CRM or a new AMS system or a new accounting software or anything along those lines is certainly going to cost money. And they took a look at what their infrastructure was currently and decided that they needed to have some money available for some enhancements down the road, as well as some risk mitigation. And then, as I mentioned earlier, there has been consolidation in the industry, and this organization operated or operates in an industry that has seen some consolidation. So they wanted to be able to position themselves to recognize that the revenue that they've been accustomed to receiving may not always be there because as some of these consolidations happen, the revenue may decline. So when you aggregate these risks, they came up with a risk reserve of about 4.3 million should, again, all of these things happen. So let's sort of summarize the exercise that we went through there. And again, at the onset of this exercise, the organization had reserves in this example of about 6 million against a base of 10 million, so a 60% reserve ratio. Their proposed strategic opportunities reserve, as you may recall, was 3 million with a risk reserve of 4.3 to get to a targeted reserve of 7.3 million. That's what they wanted to target for 2023. That doesn't necessarily mean they're going to get there, but they want to target that. And it provides a rationale not only behind maintaining the reserve they already have of 6 million, as you can see below, but also, going down that path to attempt to increase those reserves because of the aforementioned slides and the process that they went through. So again, it was going to be a proposed increase of about 1.4, again, to get to a targeted reserve of 7.4 million. So, sort of just wrapping up here, there's certainly, as we all know, a level of risks and opportunities facing nonprofits in the world. We've talked a lot about IT. Your job and your organization's sort of charge is to, whether you're a membership organization, continue to provide that value to your membership. And whatever that's defined as in your organization, chances are it's going to need money and need funds in order to execute upon that. And oftentimes those funds, as we well know, can be above what you're charging for membership or what you're getting, on the C3 side through a donation, So meeting those member needs and constituents needs is another focus of having reserves. We all are aware of the loss of grant funding and the need to sort of reposition an organization to look for other opportunities, other financial considerations around world and domestic events. So again, you really have a responsibility as a nonprofit to at least go through the exercise of assessing where your risks and I would say opportunities are to meet these needs and attempting to align those risks and opportunities with the reserve that you have or the reserve that you strive to have down the road. Not only does that give you sort of a benchmark to achieve, but it also gives you a defensible position for continuing to, have these reserves for these types of events. So that is the content that we had today. We certainly appreciate your time. And we would now like to open it up for any questions. Nathan, I don't know if anything's come through. If there are any questions or anyone wants to throw anything out there in the last few minutes that we have, we'd be happy to entertain those. I don't see anything in the webinar chat, so we'll hold it open for another minute. Nathan hasn't seen anything either, so. But I would say, as you can see, certainly if you don't, want to ask anything here in a public forum, you can see Melissa and I. We have our email there at the bottom of our pictures. This is a space that we both enjoy working in very much for a very, very long time, and we would welcome the input, the questions, and the dialogue with you should you have any down the road. So certainly don't hesitate to reach out to us. So with that, we would like to thank everyone for attending today's discussion. Please follow us on social media at GRF CPAs. Certainly visit our website for upcoming events and alerts. Please remember to complete the survey that will automatically appear following this session so that you can earn your appropriate CPE. And we thank you for spending a portion of your morning with us, and we wish you a very, very pleasant rest of your day.